This episode is brought to you by Coffee Mate. Coffee Mate is the world's biggest coffee lover because we love all the ways you enjoy. Wait. Coffee Mate can't love coffee more than me. I'm a foodie. I went to Kyoto just for a nitro matcha latte. What? Oh, I have to finish the ad. Coffee Mate, for the love of coffee.
What's new from Apple? There's the new iPhone 16 Pro, built for Apple Intelligence. And it comes with the all-new camera control, giving you an easier way to quickly access your camera tools. The new Apple Watch Series 10 has our biggest display and our thinnest design ever. And this? It's the sound of active noise cancellation, now available on one of 2 new AirPods 4 models. So quiet. Check out all of the new products and new features at apple.com. You can even buy yourself something new. See apple.com for product availability updates. Apple Intelligence coming this fall.
Hey guys, welcome to this week's podcast episode, and I've got a legacy guest for you today, Scott Stanfield, coming out of Ohio, and he's a real estate investor. He's the Turnkey rental guide. So today's talk is going to be all about real estate, and a lot of the audience, they are more advanced. So we're going to talk about the economy, interest rates, the election, and really going to be a fascinating discussion. Scott, welcome.
Thank you. Thanks for having me.
Yeah, I always love getting a sense how you got started and brief intro, and then we'll dive right into the meat of the conversation.
Yeah, so I guess I got started, it goes a little bit further back. So I finished my PhD in 2009, and I started working this when I first had a little extra money, and I was trying to figure out how I wanted to invest that money. And that's when I started to really look at real estate seriously. And so I started back in that period, but it was with some luxury condos and whatnot in the Cincinnati area. I self-managed those and then sold them. And then a few more years later, that's when I got on to turnkey rental investing. And so that's actually my start. I just had extra money, wanted to invest it, and I liked what real estate had to offer with depreciation and just some of the other benefits. And so it was a good fit for me. And that's why I went that direction.
Yeah, it's really, I think for a lot of the audience are doctors, lawyers, dentists, high income. Real estate is that tried and true asset. You put it in, so you still have to maintain it and operating costs, but it's not something where, the dollar is getting devalued, and it's
one of the best inflation hedges you can ask for, especially if you buy with a mortgage. So yeah, it's actually really good for that.
Yeah. The interesting thing is you're turnkey real estate investing. So a lot of the audience, they're not familiar with that. So what is that? And talk about it.
It's really just a long-term rental strategy, pretty much what everybody is familiar with, except that you're sourcing your deals through a turnkey provider. And what a turnkey provider does is simply buy that distressed property. They already have crews, they do the renovation work, and then they have in-house management. They're going to manage the property going forward. And at this time, they're ready to exit. So I'm stepping in really at their exit and then buying that asset. And so for me, anyways, it made a lot of sense at the time because I was working so many hours that I had a way to source my deals so long as I find good providers, which I was able to do. And then, of course, completely outsource that entire rental business in just one purchase. And then going forward, it's really about managing the portfolio and managing your managers, and really the time you spend working on your business is pretty small. And so as a working professional, that was crucial for me. So that's what turnkey investing is.
And one thing that the audience may ask when they're listening to this is, how is turnkey investing different from like a syndication or even like a
Sure. Yeah. So when it comes to syndication, I'm the only one that owns this property. So I'm the one that makes all the decisions. I have full control. It's just my money that goes into this deal. It's not through a syndicator. I'm not paying syndication fees or anything like that. And so, again, it's more like owning a just traditional rental business. And I could do syndications. I prefer this. I like having full control over the investment vehicle. I decide when I want to refinance. I decide if I'm going to sell or do an exchange or something like that. And so for me, it just makes a lot of sense. And then you also asked how this differs from a corporation.
like
Sorry.
No, it sounded like what you were describing is a
Mhm.
franchise, but how is it different?
Oh, no, it's definitely not a franchise. It is my rental business, right? And so you'll find turnkey providers that operate in every metropolitan area across the country. And again, it's just a business that's finding these deals and selling them to people. And you can do it other ways too, right? It's not the only way I've sourced deals. I
Yeah.
can also source deals by just a lot of times finding a good property management company who exclusively works with property management. They have clients that want properties. So you can go to them, you can talk to them, they'll have a renovation team in-house and people that will find deals for you and source them. Except that turnkey providers, what they do is they actually brand themselves as doing that for you. And so essentially think of them as just a flipper who's flipping a ready to go asset to a long-term investor like myself.
Mhm.
So yeah, it's definitely not a franchise.
Yeah, and the other thing which you touched
Mhm.
upon is it's because I was thinking, why not just do a property manager versus a turnkey? How would you decide?
The nice thing about a turnkey provider is they are specifically put together to do this, right? So they already have a network assembled to help people that they think are going to need help maybe with insurance or just different pieces like that. They've already answered some of those questions. Whereas if you're looking at an agent or you're working with a property management company, their business is really property management, right? They want to help provide some of these solutions, but that's a secondary piece for them. And so why would I go that route? It just opens up more options, right? To find more people to grow my network to, again, get into some good deals, et cetera. Maybe some areas where I haven't found a good provider. But the reality is a provider is actually specifically equipped to do exactly what I want, right? They're able to find these deals. They know their local markets. They can sell me a ready to go property. And then, of course, they have management in-house ready to go. So it's really working with them by extension, have access to their whole network. And so that's really the allure of it. And again, profits have been great. So for me, it's worked out really well. But it's not the only way to source deals. It's just a way to do it if you're very busy. And the returns are fantastic. So I can't complain about it at all. So
Yeah.
you can do better, obviously, if you source your own deals and do all that work, but your hourly rate won't be nearly as high. It won't even be a quarter as high. And so
Yeah.
for me, there's just something to be said for outsourcing a lot of that activity.
Yeah, it's interesting because a lot of the doctors, again, their time
Right.
500 plus per hour. And
Right. And they're busy, very busy.
a follow-up question, because you
Mhm.
mentioned really great profits, and
Yep.
what are the typical fees, like percentage wise or per deal, that you should be expecting versus if you do it yourself or you have a property manager
Yeah,
or
sure. Yep. No, actually, think of it as just a normal transaction. So there are agent commissions that are involved. I don't buy it unless it appraises. So there is no additional fees there. If it doesn't appraise and it doesn't meet my criteria, I just don't buy it. So that way I know I'm getting something at value. And then, of course, going forward, once it's in their management company's control, it's the same as any other management company. Some of them are going to be 8% monthly fees or 10% fees. Some of them have a flat rate, maybe $100 a month. And then they'll have some other charges on the back end where they're going to try to, charge for Upwork, that sort of thing. I look at the whole package, right, and decide if I want to actually pay their fees or select a different company. It's the same thing if you're selecting a property management company, and the fee structures are actually identical. And so, really, there isn't any trade-off that way. Again, they make their money when they sell you the house, right? So now all their money's out plus profit, and now they're going to manage the asset going forward for you. And so for them, they have no money in that deal anymore, but they do want to maintain that relationship with you so that you'll continue to buy properties from them. And so it creates this revenue stream for them as well through their management. And so that's essentially how the fee structure works for this.
and what happens, for example, let's say, just hypothetical example, a tenant calls you 3 a.m., toilet's
Ah, they
broken.
don't call me. They call the property manager. I don't even know my tenants' names, and I like that. And I joke about that for a reason. What it shows is that it's truly been outsourced, right? I have somebody else that's doing the day-to-day activities. I am very much in the know on it, right? Every month I look over my P&L statements. I look at my accounts, I reconcile, make sure all the stuff is working right. I look at specific metrics to gauge how property management's doing. I look at gross rent collected, and I look at percentage of the gross rent that's going towards variable expenses like maintenance, repairs, and turnover. And I like to see that number about 10%, right? Something reasonable. And if it's high, then it tells me I have a problem. I need to dig a little deeper with that manager. So the reality is, no, it's very much they handle all the calls. I don't do any of that stuff. My monthly time commitment's about 2 hours on average or less. Now, there are months that I work more, right? If I want to buy another house or something, I'm going to start to research markets or something like that. But as far as maintaining and managing my portfolio goes, it's less than 2 hours, roughly.
Interesting. Yeah, we'll kind of shift gears because we talked about this.
Sure.
With given economy and interest rates, we got presidential election. How are you positioning yourself in this environment?
Yeah, so I actually started positioning myself maybe a little too soon, but January of 22 was the last time I bought properties. And the reason was that I already had specific criteria in place. It was based on historical performance of real estate. I was looking at things like the market cycle. And at that time, I gauged that it was the final quarter of the expansion phase. And so my criteria were very specific. Once I hit that point, I don't want to buy more property. I want to let that last push of appreciation lower my loan to value ratio so that I have a lot of equity, and then I could navigate whatever was coming. Because after expansion, obviously, is going to be hypersupply and then recession. That's how that theory goes. And of course, I was looking at economic indicators and things like that just to help confirm where I thought we were in the cycle. And so that's how I began the position. At that time, when I made my two last purchases, this was in Alabama, my loan to value ratio was about 68%. I had just refinanced to capture the low interest rates. I pulled money out. I bought 2 new houses. And so once I did all that, I was about 68% roughly on my loan to value ratio. And then what I did was that last push from appreciation helped drop my loan to value ratio to about 50%. And so now I have a lot of flexibility. So if there's a problem in the market, I can navigate it pretty easily. So that's how I began to position myself. And of course, since then, what I've been doing is just maintaining high cash reserves and things like that. Looking for better opportunities right now isn't really a great time to be necessarily buying, although there were some opportunities. For example, cash purchases with interest rates raising would push your rental rates higher. That's a direct correlation. So you could have done a cash purchase, maybe at an 8% ROI or something like that with on your cash on cash return, and then let the market push the rental rate up and then increase that. So I did evaluate some strategies like that, but ultimately I was happy with where my portfolio was and how I had a position to ride through a recession. I knew I would come out with really good cash reserves. So even if I'm wrong and this is just a momentarily dip and then we take off again, I'm in a great position, right? I have low interest rate, I have cash flow, I have cash reserves and equity. So I can begin to position however I want at that point. So that's how I've been trying to look at it. Although, just full disclosure, I'm really waiting to see what happens with the election and just how, I guess, crowd mentality changes and shifts, just to see what that's going to do. So that's currently what I've been doing with positioning my portfolio and how I position and why I've positioned. I think the why is probably more important.
Yeah. I was gonna ask you about the upcoming election, and some people are predicting. Here's the big question: is we got a changing rental market because now we have like work from home and or renting and commercial struggling. Where do you see like real estate going? Like kind of potential scenarios where obviously we're at a cusp. I'm just trying to get ideas.
Yes. It's interesting you asked this. So I was recently evaluating this again, and I do this periodically. And there are so many risk sources in the market right now that could be a catalyst for a bigger problem. And it's exactly why I'm happy to be, I don't want to say sitting out. I'm just not buying, instead I'm managing what I have. But the point is, to your question, office space is all-time high vacancy rates. And so the folks that own that, they either have to try to figure how to reposition their assets or refinance or whatever it is they need to do. But I can't imagine that they're in a good situation. You cannot have historically high vacancy rate, the highest ever recorded, and be okay. It doesn't work that way. You need income to pay your bills, and they don't have that. So I see a big problem there with office space. Retail at one point I really thought would be a problem, but that has seemed to find their balance with e-commerce, and you can actually see some of the fundamentals getting better with retail. So I think that's not much of a source right now. And then when you look at multifamily, that's another issue too, right? It was a recent report by, I believe it was Fannie Mae, that was describing some of the hardships that multifamily is experiencing right now. And of course, it's market dependent, right? Some markets are still short on supply, others are oversupplied. And so some of these oversupplied markets are starting to provide a lot of concessions and just different things like that. But and this is what I found interesting, one of the key risks to multifamily was actually single family. And because the price points were so high and the barrier was hard to get into, it's driven demand for multifamily. So what happens when you start dropping rates in demand if it does pick up for single family and now it's more affordable? A lot of that demand for multi, which is already struggling, is going to disappear. So what happens to multi? I really don't know the answer to that. So there's a lot of different risk sources, and I haven't even gotten into the political ones with a presidential election. It's exactly why I'm waiting to see how all this resolves. It's just a little more risk than I can tolerate for my risk tolerance. But you asked some of the sources that I am monitoring. Those are some of them, and obviously I'm sure there's more. Usually, if you can identify the source, if people are all talking about it, that's not what causes a crash or a major slowdown recession. So I'd love to know what all I'm missing. I'm sure there's plenty.
Yeah, I was after the recent jobs report on Friday. Then
Yeah.
what do you see? Some people are saying they said that they call it the D inverted yield curve, and they said that's harbinger of recession. Do you see
Well,
us?
it's accurately predicted almost, I think, every recession, but there's a huge lag with it too. So it's yeah, but I have looked at that some. Sorry, go ahead. I didn't mean to cut you off. I got excited. I was like, oh, I know that one.
Yeah.
But
Yeah,
anyway,
I think that what you're doing is a smart way, and just because just things are just so uncertain,
right.
and we're coming out of a COVID, and just everything's just so. How can people find you and find out more about you, learn about Turnkey, your ideas? You obviously have a lot of interesting ideas, and reach out to you.
Yeah, first off, like the ideas that I talk about, it's really market generated data that I try to interpret. So actually, I'll look at the plots, share the plots, etc. So it's not just wild theories. I want to make sure people realize that it's important to use market driven data when you're trying to navigate a market. I don't want you to just think, oh, I'll just read this and no. So that's really market generated data. That's key. Where to find me at? My website is at scottastanfield.com. It's put together just to help people who want to learn more about turnkey rental investing. I have an email address there, that sort. I always respond to emails. I actually do want to help. So if you send me an email, I will respond. If you want to learn more about turnkey rental investing, there's plenty of information there. And there's a lot of tools and stuff like how I select markets and things. It's all free. The only thing I sell is actually a book. But anyway, so yeah, if you want to learn more, that's the best place.
Yeah, I really enjoyed this conversation and the pace, and just very timely relevant. It's September 10th, and it'll release in the next 1 or 2 days, and really interesting. And for the audience, be sure to give Scott's socials a like and follow, and reach out to him for more education and more relations. And thanks so much for coming on.
Thank you. Thank you for having me. It was a pleasure.